Hello, friends. Welcome back to another episode on marginal costing. See, in this particular module, we are going to understand about the basic concepts of the marginal costing, the terminologies in which we may use in case of a marginal costing, and how to calculate basic calculations about the cost volume profit analysis, the PV ratio, the break even point, and calculation of various other items like the profit and sales, margin of safety, etc. First, let us understand what are the terminologies in which we may use in case of a marginal costing. First, you need to understand the concepts of the cost. Cost is an expenditure incurred for manufacturing a product or rendering a service. As and when any amount of expenditure is incurred in order to manufacture or to sell a particular product, purchasing the material and selling a product, it's quite obvious that you'll be incurring certain amount of expenditure. The total expenditure is called the cost. The cost may be classified into two categories. One is variable cost and fixed cost. The variable cost is a cost where it varies according to the level of output. As and when the output increases, invariably the cost also increases. For example, to manufacture 10 units of output, you may incur some 1000 rupees. If you want to manufacture some 20 units, and obviously the expenditure increases proportionately. That kind of an expenditure is called variable cost. The example for variable cost is maybe the material cost or maybe the labor cost. Another one is called the fixed cost. Fixed cost is a cost which remains fixed in nature, irrespective of level of output, whether the output is high or maybe a low or maybe a moderate or even maybe the zero. The cost remains unchanged. That cost is called fixed cost. For example, the rent paid for the building, the factory. The amount of rent paid by the factory may be, for example, 10,000 rupees. Whether you produce 10 units, 100 units or 1000 units or maybe a nil production, the rent being 10,000 rupees the same. That's what. Another example may be, for example, the stationery. Even the stationery used in the office, irrespective of the output, the output is 10 units or 100 units, the stationery remains the same. So this is what exactly broadly classified the cost into fixed and variable for marginal costing purpose. So combination of this variable and fixed cost is called total cost. This is what the cost incurred for manufacturing a product or rendering a service. After determining the value of cost, you must understand what is this marginal cost. Marginal cost is a cost which varies according to the variations in the volume of output. Any kind of an expenditure will remain fixed to certain level of to certain extent. We may call it as semi-variable or semi-fixed cost. As and when the output increases by an addition of every unit, the cost may slightly increases. So that's what exactly you are going to understand in case of a marginal cost. So the marginal cost is defined as an amount at any given volume of output by which aggregate costs are changed if the volume of output is increased or decreased. As and when the output increases or decreases, the cost also proportionately increases or decreases. What is the amount, aggregate amount which has been changed, whether it is a plus or maybe a minus, that will be treated as marginal costing. So let us understand in an equation, in an example way, how this marginal cost can be identified visibly. Take for example, in order to manufacture 100 units of an output in an industry, you may incur 15 rupees per unit, 15 rupees per unit. That comes to 1500 rupees. For 15 rupees per unit for 100 units, that amounts to 1500. Fixed cost, that may be an example for 1000 rupees. So the total cost comes to 2500. Say material cost or labor cost, that is treated as variable cost. Fixed cost, for example, the administration expenses, so printing, stationery, rent and all those things. So totally put together, you may be incurring 2,500 rupees to manufacture 100 units. This is an example. As and when if the output may increase or decreases, what will be the effect? Take for example, you want to manufacture 200 units. See, normally the tendency is for 100 units it is 2,500, and for 200 units a layman understands that it may be 5,000 rupees. That is wrong. So how it is to be identified perfectly? The way in which we are going to classify the cost as the fixed and variable way, variable per unit remains the same. So for 1 unit it is 15 rupees, for 200 units it comes to 3,000 rupees. That's called the variable cost. And the fixed cost of 1,000 rupees remains the same, whether it is 100 units or 200 units or 50 units or 300 units, the fixed cost remains the same. So fixed cost is taken as 3,000 and the total cost is 4,000 rupees. 3,000 plus 1,000, 4,000 rupees. Now you can identify, see in the earlier we had an assumption that for 100 units where the total cost is 2,500 and for 200 units we felt that it may be around 5,000 rupees. It is not 5,000, it has come down to 4,000. Now the terminology in which we use as far as the marginal cost is the cost which is increased for the additional intake of any kind of a production. For every additional 1 unit of production, what will be the extra cost in which will be incurred, that is termed as the marginal cost. Now the cost for 100 units is 2,500, the cost for 200 units it is 4,000, and an additional expenditure is called as 1,500, that is termed as marginal cost for 100 units. So this is what exactly we need to understand, what exactly the concept of marginal cost. The same thing we can further extend if you want to find out the profit as such. For 100 units the profit may be around, so 500, assume that the selling price is at 30 rupees. 30 rupees per unit, your sales volume is 3,000, and if the same rate at which you wanted to sell all the 200 units, your sales revenue may be around 6,000, your profit is 2,000 rupees. So for 100 units your profit is 500, and for 200 units your profit may go up to 2,000 rupees. This is what exactly the variation with respect to the profit is concerned. Right. Then after identifying this marginal cost, the difference between the actual and the additional expenditure in which you may incur, then comes to the marginal costing. Marginal costing, it is a technique in which we are going to use for ascertaining the marginal cost in order to know the effect on profit of changes, the volume or maybe the type, by differentiating between the fixed cost and variable cost. So marginal costing is a tool in which we may use for ascertainment of marginal cost. Next is, in order to identify any kind of marginal cost, one has to understand by bifurcating the expenses into variable and fixed. For that we need to prepare a simple statement called marginal cost statement. That statement goes like this. Take the sales volume as a base. From that total sales, deduct the variable cost portion. By deducting the variable cost portion, you are going to arrive the contribution. From this contribution, deduct the fixed cost portion. So by deducting the fixed cost portion, you will get the profit. See, the first half is more important. Sales minus variable cost is the contribution, and fixed cost that is required for calculation of break even. So by preparing this marginal cost statement, it will be useful for further calculations such as PV ratio and break even point. So what is that PV ratio and break even point? In order to understand those terminologies, first you need to understand different tools and techniques in which we may use in marginal costing. The first one is called the contribution. Contribution is a reward for the efforts of an entrepreneur. Any kind of an effort which has been used by an entrepreneur, whatever the benefit in which he is going to get back from his hard efforts is called contribution. So out of the total revenue, certain amount of expenses or preferably the variable expenses that will be deducted in order to arrive the contribution. So in simple meaning that we call it as it is a profit. The reward is called it is a gain for an entrepreneur or a business. A reward is called it is a profit, but the profit means it is not net profit, it is gross profit, because it that profit not only includes only the variable expenses, that excludes fixed expenses. So this profit also inclusive of the fixed cost. So that has to be deducted in order to get the net profit. So contribution in simple meaning that it is the gross profit in which is going to derive out of meeting the variable expenses. That's called contribution. Next is the formula for calculation of this contribution. The contribution can be determined as sales minus variable cost or fixed cost plus profit. See, these two equations can be derived out of marginal cost statement. Sales minus variable cost is contribution. Contribution is equivalent to fixed cost plus profit also. Or another way is sales minus variable cost equals to fixed cost plus profit. This is the mathematically the contribution can be calculated. So then comes to the profit volume ratio. This profit volume ratio can also be called as a contribution ratio, popularly called as the contribution ratio or PV ratio. Now, this ratio in the sense it is expressed in relationship between two items, the two variables, association of two variables such as contribution and sales. So, in order to calculate this PV ratio, this ratio will be expressed in terms of a percentage between the contribution to sales. What is an amount of contribution on sales is expressed in terms of percentage, that is called contribution ratio or PV ratio. This PV ratio can be calculated by a mathematical formula, that is contribution divided by sales into 100. This is the one first formula to be normally PV ratio will be calculated if you know the contribution at sales. See, certain times where the certain problems having only the profit and sales, you won't be aware, you may not be available as far as the contribution information. Under that circumstances, the PV ratio can be calculated as the PV ratio can be calculated on the basis of per unit also. Per unit, when the sales and the variable cost per unit is given, even on that basis also the PV ratio can be calculated, but the ratio in which you are going to get, it remains the same. Assume that contribution by sales into 100 you may get as 30%, even the contribution per unit divided by selling price per unit multiplied by 100, you get the same answer, the same percentage. Another way is when the profit and sales is given for two different years or for two different periods, even the PV ratio can be calculated as the changes in profit or the difference in profit or the increase in profit divided by sales into 100. These are the three different formulae available for calculation of profit volume ratio. This comes to the break-even point. Break-even point, it is a point at which the production or the sales, the volume of production or the sales where there is no profit or loss. The total amount of production or maybe the sales which has been made by an organization at cost price. That means to say, in simple, we'll call it as cost is equals to revenue. So it is a point of no profit, no loss. The company derives a profit nor incurs a loss. So whatever may be the total cost of production is equivalent to the total sales. That is called break-even point. This break-even point can also be popularly called as CVP analysis. This kind of analysis which is required in order to analyze the position of an organization at what point the company is getting certain amount of profit. At what point the company is maintaining the cost is equivalent to the revenue. So beyond the point at which the company may get certain amount of profit, below the point at which the company may incur the loss. So in order to identify the point at which the company is going to break even, identifies, that analyzes the position that it is an alarming situation for an organizing body or maybe the managing body, see that in order to have a whistle on getting good amount of profits. If not, the company is not in a position to get profit, see that the company should maintain the break-even level. If the line or the point at which it falls below that, there are chances that the company may incur losses. So that break-even point is a point where the company's revenue is equivalent to the cost. And this break-even point can be calculated as fixed cost divided by PV ratio. This is in terms of break-even sales, that is in terms of rupees. And similarly, break-even point in units can also be called as fixed cost divided by contribution per unit. Only the difference is, if you take divided by PV ratio, it is break-even rupees. If you divided by contribution per unit, it is in terms of break-even in units. Another way is, if you calculate break-even units, if you multiply with the selling price per unit, then you will get break-even in rupees. It is not units, break-even rupees. Next is margin of safety. What is this margin? Margin of safety. Margin of safety is the point beyond the break-even point. Break-even point means there is no profit, no loss. Wherein if that crosses, where the sales revenue crosses beyond that margin of safety level, where the cost diminishes, and beyond that level is called safety level, that is called profitability position or profit area. So margin of safety can be obtained by subtracting break-even sales from the total sales. Say for example, where the company has made a sales of around 5 lakh rupees, at 5 lakh rupees. In that 5 lakh rupees, the break-even sales may be, for example, 4 lakh rupees. At 4 lakh rupees, the company's profit is zero. At 5 lakh rupees, the profit may be around some 10 or 20,000 rupees. So beyond that 4 lakh rupees of sales, beyond that 4 lakh rupees of break-even sales, that portion is to be called as the margin of safety. And this margin of safety is very much useful to determine the financial soundness of the business organization. That shows the profitability position, whether it is sound or maybe unsound. Higher the margin of safety, that shows the higher financial position, and lower the margin of safety shows that it is the financial unsoundness of business organization. So it's always better to have a good amount of margin of safety than that of PET. Next is angle of incidence. This angle of incidence is an angle formed at the intersection point of total sales line and total cost line. The intersection point pertaining to total sales and cost line is called break-even. And beyond that level, that is to say, intersection level of total sales line and total cost line in a formal break-even chart is called angle of incidence. This angle of incidence can be can be analyzed neatly by looking at the graph. Say for example, at the point level A and C, see A is at the 0 to A is called as the quantity, number of units that to be sold. At point level C, you will be getting the revenue. So where the total sales revenue is to be termed as curve line S, and the total fixed cost is called as the slant line is called as the fixed cost, and the variable cost carries in excess of the fixed cost. This is to say, it is total cost. Now, where the total cost line and the sales line intersect each other, this is called break-even point. Beyond this point, on your right hand side portion, that is to be called as the profit area. On your left hand side portion, this is called loss area. Even this is also called as loss area. Then the angle of incidence in which we may get beyond this level, beyond break-even level, this is to be treated as the angle of incidence. Let us understand these calculations by way of by way of one illustration. So how to solve, how to calculate, or how to determine, or how to arrive different values of break-even point or the PV ratio and so on. Say assume that the selling price for a unit of production is 120 rupees, where the product is sold for 120 rupees per unit. In that, our variable cost is 90 rupees per unit, fixed cost is 1 lakh rupees, 1 lakh units, 1 lakh rupees, and output is 5000 units. As the selling price is given as 120 rupees, variable cost is 90 rupees, fixed cost is 1 lakh, we need to prepare a simple marginal cost statement for this question in order to calculate PV ratio, break-even point, and break-even sales value. As we know that the selling price is the price at which we will be selling, and out of which whether you may get profit or loss, that can be identified by preparing the marginal cost statement. See, 5,000 units were sold at the rate of 120 rupees, that arrives the sales volume around 6 lakhs. These 5,000 units are manufactured with a variable cost of 90 rupees, that comes to 4.5 lakhs, and your fixed cost comes to 1 lakh. So totally put together, what exactly the profit in which you are going to derive for these 5,000 units of production and sold. See, the marginal cost statement, as you know, that the sales minus variable cost is called contribution, contribution minus fixed cost is called profit. Now, it is given that the selling price per unit is 120 rupees, whereas variable cost is given as 90, therefore 120 minus 90, the contribution is 30 rupees. This is the data which is given for 5,000 units, therefore total sales volume for 5,000 units, 120 into 5,000, you are going to arrive at 6 lakh rupees, and the variable cost for 5,000 units, that comes to 4.5 lakhs. Therefore, sales minus variable cost comes to contribution, that is amounted to 1.5 lakh, and deduct the fixed cost that was given in the question as 1 lakh rupees. Therefore, your profit is 50,000. This is a basic statement in which we prepare for further calculation. First come to the first and foremost the PV ratio, profit volume ratio. The formula for calculating PV ratio is C by S into 100, contribution divided by sales into 100. So you know that in this problem, while preparing the marginal cost statement, our sales position was 6 lakh rupees, our variable cost position was 4.5 lakh rupees. Therefore, the sales minus variable cost comes to contribution, that is called 1.5 lakh. By substituting these values in the formula, that's 1.5 lakh over 6 lakhs into 100, you'll get a percentage of 25%. That is called profit volume ratio. This profit volume ratio, always it will be expressed in terms of a percentage. Then calculation of break-even point or calculation of PV ratio if per unit is given. See, in this problem we are aware of what is the per unit. So PV ratio can also be called as can be calculated as contribution per unit over selling price per unit into 100. So how to calculate this if per unit is given? You know that the selling price per unit given in the question is 120 rupees, whereas the variable cost per unit is given as 90 rupees. Therefore, contribution equals to 120 minus 90, that comes to 30 rupees. So by substituting these values in the PV ratio as CPU divided by SPU, say contribution per unit divided by selling price per unit, you will get the same percentage as 25%. That's how we need to calculate this profit volume ratio even if per unit is not given. Next is the break-even point. The break-even point, the formula is fixed cost divided by PV ratio. Already PV ratio is calculated as 25%. So based on that, this PV ratio can also be calculated. So for this, you need to have the fixed cost that was given as 1 lakh rupees, PV ratio that you have calculated as 25%. Just substitute these two values, you will get 4 lakh rupees. So break-even sales equals to 4 lakh rupees. Once if you calculate this break-even sales, if you divide it by the selling price per unit, you will get break-even units. So if you know the sales, you can calculate units. If you know the units, you can calculate break-even sales. So we know the sales as 4 lakh rupees divided by 120 rupees is the selling price, you will get break-even units. Or if you know the break-even units multiplied by selling price per unit, you will get the break-even sales volume. So let us see a separate formula for calculation of break-even in units. That is to say fixed cost divided by contribution per unit. If you take the PV ratio, you will get break-even sales. If you take contribution per unit, it will be break-even point in units. So fixed cost was 1 lakh rupees and contribution per unit we have derived as 40 rupees, that is 120 minus 90, 40 rupees. Therefore, break-even point in units equals to 1 lakh divided by 40, 2500 units. So this is how a separate formula, or otherwise the total break-even sales divided by the selling price you will get break-even units as 2500 units. Like that also this can be calculated. This is how 2500 units into selling price is 120, that comes to 4 lakhs. Or if you know the break-even sales in the previous one, that is the 4 lakhs divided by 120, you will get 2500 units. These are the ways in which you can calculate either the break-even units or break-even sales. So this is a simple problem in which we have calculated for this marginal costing, and hope you have enjoyed this presentation, and thanks for listening. Thank you so much.